Stephanie, we've heard from basically everybody. I'm trying to think who we still have Goldman. We still have Goldman to go, but it's been pretty good across the board.
It's been very good across the board, and the themes are strong investment banking, strong equity trading, even FICC, even though it's down year over year, it's still up from 2019 levels. M&A is awfully strong. The efficiency ratios have actually come down, which is really encouraging. So costs are coming in. And I think the financial strength, if you look at the common equity tier number one, those numbers are actually in the double digits, which is really great. So I think this sets up for going forward, operating leverage for the group. We saw it with Bank of America. We saw it with Morgan Stanley. We're going to see it with all these others over time, especially if rates go higher.
Right. Ken, one of the issues is we've seen these stocks move already. And so the question is, how much more do they have to move?
So the banks put in a strong quarter. It's a great base period. So now investors have to extrapolate into 2022. What is the trajectory for loan growth, rates and the magnitude of rates, and then the capital markets, and putting them all together? It's now a question really of getting more oomph in terms of performance. But you know what, Andrew? When we look year over year, Street consensus has revenue and earnings down next year. So I think what we might even hear from David Solomon today, we heard it from James Gorman the other day, is we're giving you everything we can on earnings. Now let's get a higher multiple. Many of these banks are trading the low teens. And, you know, Stephanie's a value investor. You got great companies like Schwab at 21 times earnings, BlackRock at 24 times earnings, and with large growing wealth businesses at Goldman and Morgan Stanley, they're going to pitch for a higher multiple because they're doing everything right in terms of execution and earnings.
Steph, should they get the higher multiple?
Yes, they should, and certain companies should get even a higher multiple. So like Bank of America, that was a flawless quarter. So can they do that a couple of quarters in a row? If they can, then they will get a higher multiple. The problem is it's been kind of uneven. Morgan Stanley should get a higher multiple because they have been executing 4 quarters now, right? I mean, now we're getting used to them actually delivering. Should Wells Fargo? Not so much, but they don't need to get a higher multiple. They just actually need to make progress in their restructuring. Citigroup, same thing, right? I mean, those are the 2 cheapest names. Wells and Citi are the cheapest for a reason. But there are opportunities for them to make improvements. So they don't need a higher multiple. They just need to deliver. But these other names, if we can see consistency, you should see a higher multiple and just better earnings overall. And again, operating leverage. Earnings should move higher as costs come down and then the top line can go up.
On the value play, Steph, I know you like Wells Fargo. Do you like Citi?
I do like Citi. I don't think yesterday was really great for either of them, right? I mean, but I don't think that I didn't think that Wells should be down as much as it was because it was really just in line and they're making progress and it's a slog, Andrew, right? Citi, I do. It's 0.8 times book, right? And they're giving you a good yield. I thought that the quarter was kind of mixed. They did well on investment banking, not as good as Morgan Stanley, but I do think that they have opportunities in net interest income as well as loan growth over time. That is a restructuring story, too. It's just a little bit on the early side.
Shepard Smith here. Thanks for watching CNBC on YouTube.